OpenAI is currently generating an annualized revenue of $25 billion. They are scaling top-line cash flow faster than any traditional software company in history. This chart shows exactly how that cash is distributed. You can see a massive revenue bar building up, but it immediately gets drained by a secondary pipeline for compute and inference costs. For every single dollar of revenue the company earns, it loses an additional $1.22, a negative 122% non-GAAP operating margin. Extrapolating this trajectory, projections show the company burning through $14 billion in 2026. The physical drivers behind this cash burn are extreme inference and training compute requirements. Every time a user interacts with a model or a new generation of AI is trained, the hardware costs scale with use. Traditional software-as-a-service platforms get cheaper to run as they grow. You build the application once, and serving the millionth customer costs almost nothing. OpenAI lacks these standard economies of scale, creating a financial paradox where hypergrowth actually accelerates its losses. To understand the severity of this burn rate, we have to look at how OpenAI's financial reporting compares to the rest of the generative AI market. Their primary rival, Anthropic, has actively claimed a superior level of capital efficiency, positioning themselves as having a much earlier path to profitability. OpenAI's accounting method deducts Microsoft's 20% Azure share before reporting top-line cloud sales. Anthropic, however, books all cloud partner sales as top-line revenue, then buries the cloud provider's cut further down the ledger as a marketing expense. Raw revenue claims in the AI arms race are heavily distorted by these differing accounting standards. The gap between GAAP and non-GAAP reporting allows these labs to move numbers around a spreadsheet, masking the true underlying cost of their infrastructure. Despite these infrastructure costs, OpenAI is actively driving towards an initial public offering in late 2026 or 2027. They are targeting an eventual market capitalization of roughly $852 billion. The hurdle facing this timeline is that public institutional investors operate under strict scrutiny. They demand a mathematically sound path to profitability, not just impressive top-line growth. Right now, OpenAI relies on a circular financing loop. They raise billions in private capital solely to pay hyperscalers for the compute required to keep their models running. During the rigorous S1 scrutiny of a public filing, that kind of cash loop will be a significant liability. Looking at this chart of weekly active users, we can see ChatGPT's adoption climbing sharply, but then flatlining. The user base has stalled near 900 million, missing the company's internal target of reaching 1 billion users. The underlying bottleneck is user conversion. Only 5 to 6% of those 900 million active users actually convert to paying subscribers. To bridge this gap, OpenAI executed an immediate strategic pivot. They began injecting targeted advertising into their free and discounted Go consumer tiers. Internal projections show the company targeting $2.5 billion in ad revenue by 2026. Introducing ads into a premium AI product reveals a harsh reality about the business model. It proves that OpenAI has realized standard subscription fees cannot cover their staggering compute burn. OpenAI's operating margins are limited by their reliance on a single third-party cloud provider for their compute capacity. In response, they launched the Stargate data center initiative, a $500 billion plan to build and control their own infrastructure. This diagram shows their supply chain strategy. Initially tethered heavily to Microsoft Azure, OpenAI is now diluting that monopoly by building out independent data center nodes. To execute this, they have signed new capacity agreements to connect directly with Oracle and Amazon Web Services. By diversifying their hardware supply chain across multiple hyperscalers, OpenAI now forces these cloud providers to actively compete against each other, driving down the overall price of compute. Building Stargate is the project OpenAI needs to break its reliance on third-party cloud pricing and achieve the independence required to manage its own margins. With a valuation of $852 billion, OpenAI's current subscription revenue is insufficient to support its long-term market position. To reach a scale that justifies that price tag, the company is attempting to integrate its technology into several new industries simultaneously. They are expanding their addressable market across 4 distinct vectors. The first is enterprise agents, AI models designed to autonomously automate complex, multi-step workflows like software engineering and financial modeling. The second vector is e-commerce integration. By handling transactions directly inside the chat interface, OpenAI can bypass traditional search engines and capture affiliate fees. The third vector is an AI operating system. This involves embedding native, persistent AI with long-term memory directly into Apple iOS and Windows environments. Finally, the fourth vector involves deploying highly secure, insulated models to capture classified government and military contracts. These four vectors are the required mathematical bridges to justify an $852 billion valuation in the public markets. How long do you think OpenAI can maintain this level of compute burn before the public markets force a correction? Let us know your thoughts on their infrastructure shift in the comments below. Be sure to like and subscribe for more rigorous teardowns of the private and public technology markets.